Welcome to another Mr. James Accounting tutorial. Today's topic we are going to look at one of the 2021 exam topics released by Miss ICXC from Module 3, Capital Budgeting, Part 3, Time Value of Money. So let's get right into it. So first we want to look at the time value of money. Now it deals with how the value of money changes over time. Right, the basic premise is a dollar today is worth more than $1 a year from now. Okay, everything that we use to appraise is based on that premise. Therefore, investments projects that promise earlier returns are preferable to those that promise later returns. So everything we look at would be based on this basic premise, time value of money. Here we have a present value for a series of cash flows. How we're going to calculate it. Fund investment involves a series of identical cash flows at the end of each year. It is called an annuity. Okay. In this case, what we have here is the annuity is 100 per annum, and every year at the end of the year, now this is not at the beginning, but at the end of the year, you get $100 return on your investment. Right? What will happen is the value at the end of each of these years would be different the further away you get from the beginning. Okay? So the assumption that we made just now. In order to calculate the present value of this whole series here, the changes must be, you can accumulate the changes and multiply it by 100 and you will get the present value of that series of cash flow. Okay. However, okay, when the cash flows associated with an investment project change from year to year, the formula introduced earlier cannot be used. Instead, the unrecovered investment must be tracked year by year. Okay, so let's say you have 1,000 in this year, zero in the next year, 2,000 in year three, 1,000 after year four, and 500 after year five. You cannot add up the changes over the years and multiply it by any one figure here. You would not be able to get it. Instead, you have to do the changes every year and then put them all together to get the present value of that investment. Okay, we'll continue in the next slide. Okay, here we have a sample problem which utilizes cash flows and present value. Right, so we have here three situations. You should be able to read this a bit. Um, it's very blurry. The present value tables have been formed already by accountants put together, which tells you the value of money in the future. You just have to look up the period here and the percentage in the year here. Okay, the percentage of the change here, and then you see where it coincides with your period and year, and you can read off the present value interest factor. Okay, it's worked the opposite way that interest works. Instead of you gaining interest, you are going to lose value if you hold on to your money. Okay, and Never mind that you can't see this here just now. I will show you what the tables look like that CXC will give to you. And for your exam, okay, this is what it looks like. Present value, interest factor table. You have the year here and the different percentages on the side here. You will always have the percentage that you are required to use, and if it's 12%, you will go down. It can go down to more than 9 years, 10 years, 11 years, 100 years, whatever. Okay, so this is what the PPIF table looks like, and this sample problem that we are going to use here, we wouldn't be able to use the table here, but all the figures, I will show you it on the side here that you need to work with, so you don't need to read the table. Okay, right, so we have the sample problem here. It says, congratulations, you have won a state lottery. The state lottery allows you the following further payment options. Option 1 is 13,500 5 years from now. Option 2, 2 million at the end of each year for the next 6 years. So here we have a lump sum payable to you 5 years from now at 13,500,000. Option 2 is 2 million at the end of each year for the next 6 years. You could see that 2 million at the end of each year for the next 6 years will be just 12 million, and it's not as big as this, and you might be tempted to jump into the first one immediately, but you shouldn't before you have done your calculations and appraise them. Option 3, 12,500 4 years from now. Okay, so another lump sum there, and requirement. Assuming that you can earn 10% on your funds, which option should you prefer? Okay, we get it right into it and check how we're gonna appraise those things there. Okay, so we are back with sample problem number one. We're gonna evaluate option one here, appraise it, that is 13,500 5 years from now. Okay, so it's a one-time lump sum payment of 13,500,000. The 62.621 is the present value interest factor that we got from here. So we will go down 5 years, right? And then we go to the 10% column coming across here, and that's where we got the 0.621 from. So the present value of 13,500,000 dollars 5 years from now would be 13,500,000 multiplied by 0.621. What this is basically telling us is that $1 5 years from now is actually worth 62 cents now. Okay, and when we multiply it, we will get 8,382,150. Okay, so keep this figure in mind there as we move to the next option 2. Then here we are, option 2, 2 million at the end of each year for the next 6 years. Okay, we go to the present value table, and we can get 6 years, 2 million, and we add it across. We come across the 10%, and we will get this here. Now, sometimes we have it here, so it's accumulated already for us. Sometimes it is not, and you can just add down the table all the factors at the end of each year because you are dealing with one annuity every year, right? Okay. Or if you get an annuity table like this one here, you have it already added for you. You have the 4.355 here. So 2 million, sorry, by 4.355 will give us 8,710,000. Okay, and that we might want to check back with the calculation for the first one, and we will notice that this one is actually higher. Although you get in less money, 12,000, here is 12 million, sorry. Here you get in 13.5, and this one, the present value works out to more than it did. Last one was 8,200,000, right? So it's going to be a toss up between this option 2 and option 3 now. Okay, option 3, 12,500,000 4 years from now. Okay, so this is another lump sum payment. Let's see what it would look like. Okay, so we take the 12 million, the present value of $1 for 12 million, 500, 4 years from now, and we come down 4 years, and we go across to 10%. Okay, and we'll get this figure here, 6.6830. When we multiply it, we will get 8,537,000. Again, another 8 million. Is it bigger than the figure that we had before? Solution. Okay, so here is the solution. Option 1, we got 8,382,150 for option 1. Option 2, 8,710,000. Option 3, 8,537,500. And so option 2 is the better option to take. Okay, so appraising investments is similar to this. That's what you will get to do in your problems, and take into consideration the time value of money. We'll continue. Okay, so we have here examples of cash inflows. Your typical cash inflows from your projects, it's going to be the salvage value at the end of the useful life of the investment. Remember, it's usually an investment in capital items, that is fixed assets, non-current assets, and so on. They have a salvage value at the end of their life that you can sell it for. That is a cash inflow of money is going to come in. When you have release of working capital, we know that to be current assets minus current liabilities, and usually when you release the current assets to work in the on a project, that is an inflow of cash into the project. Reduction of costs or cost savings, another cash inflow. If you can reduce your costs, it is regarded as a cash inflow or the equivalent of a cash inflow. Incremental revenues, any amount of new revenue, that's what the word incremental mean, increases in revenue, the increase only, not the old revenue that you used to receive before, but the increase in revenues called cash inflows when we are praising expenditure. The cash outflows, we have repairs and maintenance first. And again, that can come from working capital, where you inject cash into it to pay for repairs and maintenance and any form of working capital as well. Initial investment, this is the amount that you pay initially to buy the equipment. It's an outflow. Okay. Injecting working capital in is also an outflow, and any increases in the operating costs, not your old operating costs, but only the increases are cash outflows. Okay, so cash outflows is basically any new payments that you have to make concerning the project itself. So the present value of a series of cash flows, an example. We have Lacey Incorporated purchased a tract of land on which a $60,000 payment will be due every year for the next 5 years. What is the present value of the stream of cash payments when the discount rate is 12%? So what you have basically here is a cash outflow every year of 60,000, and since it is occurring the same amount every year for the next 5 years, then it's an annuity as well. Okay, and it's an outflow of cash, and the rate of the discount rate we need to look up is the 12%. From the present value table, since is an annuity, every year is the same amount, we can add up on the 12% column, or here it's accumulated already for us, right? And we come across to the 5 years, and we multiply 60,000 by 3.605, we'll get 26 216,300. We have another work example here again, and the Woodcover Hospital is considering the purchase of an attachment for its X-ray machine, cost 3,170. The life is 4 years, salvage value zero, and the increase in the annual cash inflows is 1,000. Okay, so from the use of this machine, you would make $1,000 every year, and you have to put out 3,170. It would last for 4 years, no value at the end of the year. So, should you make that investment or not? No investments are to be made unless they have an annual return of at least 10%. Will be allowed to invest in the attachment. Analysis should look something like this. I put it in a table. You can use this table if you're working a problem like this again, and or you could devise your own thing, right? We have here the years 1 to 4, and then the investment outstanding during the year. At the beginning of the first year, 3,170. Then we have the two after the next year when 1,000 comes in, we decrease it as we go on. All right. And we look at the return on the investment. You must recover the return on the investment. You can't just decrease by the cash inflow. recover of investment during the year and the unrecovered portion here. Okay, what will happen is at the end of the first year, we'll get a cash inflow of 1,000. They return at 10%, the 10% of 3,117, which would be 317, and we take out that out of the 1,000, the amount that pays back to the capital is 683. So our unrecovered portion is really 2,487, which is the 3,117 minus the 683, right? And then we bring this 2,487 across here. This is the outstanding cost that will remain. 1,000 coming in year two. Your investment, your investment will be 10% of the 2,489. So we have 249 and 751. Okay, we just round off the figures here. Accountants usually use estimates. This is being done before the project is actually undertaken. So they are uh, projected figures and forecasted. Therefore, you can round them off. And we go through the same process again. We minus the return from the 1,000, and we get the how much is actually paid return is paid back, and 1736 remains. Bring the 1736 here, and we go across for the investment. When we finish here, this column here should equal, at least equal here to make the investment worthwhile. Okay, if it does not, then it implies that the cash flow are insufficient. The Okay, so this implies that the cash inflows are sufficient to recover the $3,170 initial investment. Therefore, depreciation is unnecessary and to provide exactly a 10% return on the investment. Right? Original investment. Okay, we spoke about this a little just now. The initial investment outflow, so this in bracket indicating that a 10% factor. The annual cash inflows 1 to 4 is 1,000 multiplied by 3.17. We'll get that and we get 0. 3.17. We can look it up here. It must be equal to this figure here. It's less like, let's see, one of these here, and it a no deal. Okay, so this is taken from the present value tables where we have it already accumulated first. If it is not in accumulated, what we have to do is go and add them up one by one. Okay, we have four different figures here, and we add them up to get this. Alright, okay. Welcome to another Mr. James Accounting tutorial. Today's topic we are going to look at one of the 2021 exam topics released by Miss ICXC from Module 3, Capital Budgeting, Part 3, Time Value of Money. So let's get right into it.